Hi, I'm David Bradley. Welcome to the latest installment of OTA's Market Watch video blog, where we'll take a look at the pulse of the Ontario trucking industry in the second quarter of 2012. Much like the results from our first quarter survey, the majority of carriers in Ontario are showing that they're optimistic about the industry's prospects going forward for the next 3 months. In fact, 67% of respondents said they were optimistic, which is identical to the results that we saw in the first quarter survey. That's a bit lower than we saw at the beginning of 2012, where we reached our peak of 75% being optimistic, but significantly higher than the 55% that was recorded in the fourth quarter of 2011. However, while optimism is strong, at the same time we are seeing signs of a slowing economy, particularly in Ontario, and a continued stubbornness for recovery taking hold in the United States. What this tells me is that we have a good balance between the amount of freight being generated by the economy and the capacity in the industry to provide the service, and we have a quasi-equilibrium. So I think it's certainly tight capacity, the industry doing a pretty good job of managing its capacity that's holding it in good stead, not because the economy is generating a lot more volume. As you know, trucking is a derived demand industry, so as the economy goes, so goes trucking. So it shouldn't come as a great surprise that when we look at the volume issue, both the intra-Ontario market and the southbound U.S. markets continue to be a drag in terms of overall economic activity and the industry's economic activity. While a majority of carriers say that they don't expect any change, what has changed this time particularly are those carriers who are saying that they see a possible decline in volumes over the next quarter. While that's still a minority, the proportion has increased for both the intra-Ontario market and the southbound U.S. market. Again, reflecting the economy, interprovincial freight volumes are in fact improving, and most carriers see an improvement in that regard and are probably most optimistic going forward. And I think that's a direct reflection of the fact that the economies in Western Canada are doing rather well relative to Central Canada. The other market that continues to be strong is the northbound U.S. market, where we continue to see optimism in terms of volume in that regard, which is good. But of course the challenge there is that you have to have a truck in the United States first to be able to take advantage of that marketplace. Fuel prices particularly continue to be a wild card. And while we've seen some softening in world oil prices and diesel prices as a result over the course of the last few weeks, I expect they're going to remain volatile over the course of the summer. But the longer term trend, I think, clearly continues to be up. What all of this means for shippers, I think, is despite the fact that in certain marketplaces and in certain regions we're going to continue to see very soft growth, it will nonetheless continue to be modest, steady growth. And that, combined with the fact that we have more of an equilibrium between the amount of volume that's being generated and the availability of trucking services, as combined with the fact that costs are going up and of course the driver shortage, I think we're going to continue to see modest but steady upward pressure on freight rates. While each month may change, each quarter may change up and down a bit, again, the underlying trends of continued slow, steady growth combined with capacity tightness, I think, point in one direction. Thank you very much for watching this episode of the Ontario Market Watch video blog. We'll see you next quarter.